We may have a potential rate cut coming soon in the near future. Should that change how you're invested? I'm Derek Mazzarella with Gateway Financial Partners. I'm a certified financial planner. Let's get into it. One of the big things we've seen with the rate increases over the past 2 years or so is we've seen a lot of money pour into money market funds. So this is a chart that shows money market funds inflows or holdings going back to 1994, so 30 plus years. And what you notice here, there's a huge spike here. And actually, currently, we're holding $6.4 trillion in money market funds. And it makes sense because most money market funds today are making around 5% or so. So if you can get basically a guaranteed 5% rate of return with no risk, why wouldn't you? But the challenge is they're very interest rate sensitive. So if we look at the last rate cut we had back in 2019, you'll see basically what happens with high yield savings, which are a very similar process to money market funds. But they're basically, here's the Fed funds rate. They're going to pretty much follow this track and have the rates are going to dip down pretty quickly alongside the federal interest rates. So when we see that, you want to think, okay, I've got this money in a money market fund or a high yield savings account. How quickly are my interest rates going to drop if I still hold those funds during a rate cut? And the answer is going to be pretty quickly. So what are the other things we should be looking at? Well, one of the areas we look for income is through fixed income. So those are typically bond funds or mortgage-backed securities. And this chart here shows basically the difference between where rates were and what income was generated through these vehicles back at the end of December of 21. As you'll see here, most bonds are paying around a little over 2%. The high yield, riskier bonds are paying a little over 4%. But since then, the new starting yields have actually increased pretty dramatically. So you'll see bonds are around 5 or 6%. High yield even almost at 9%. So the starting yield, that means the income that these bonds and fixed income vehicles are earning are 8%, 6%, 6.5%. They're going to be in that range. So before anything happens, you're earning that coupon payment every single year. So it's a pretty high starting rate. And actually, the biggest rate of return from bonds in general historically has been what's the starting yield. So when you're starting at a higher rate, you're starting at a pretty good place. However, there's actually one other area where bonds can be impacted by rising or lowering interest rates. So when it comes to interest rates, let's say you have a bond paying 5% per year. And now the Federal Reserve says, hey, we're going to raise rates even further. So they're going to raise it up to, let's say, 7%. Now, would you rather have a bond that pays 5% or 7%? So everyone would say the 7%. As a result, the 5% bond, the value of that bond will drop. Now, the opposite happens when rates decrease. So let's say the rates drop from 5% down to 3%. Would you rather own a 5% bond or a 3% bond? Everyone's going to say the 5% bond. So in this scenario, the value or the price of the bond is going to go up. So not only do you get the higher yield from the starting yields, you get the price return. So let's look historically how that's happened from other rate cuts before. So here's a slew of other examples going back to 84, 2000, 2018, and look how they performed 3 months after, 6 months, a year, 3 years, and 5. What you see here on average, three months out, you're looking at 5% on average, 8.8% 6 months, almost 14 1 year after. 3 years after, you're over 10. In 5 years, you're averaging 8% per year. The other thing to notice here is that it is a 100% positive rate of return. So every time these rate cuts happen, bonds have gone up every single time. This doesn't mean it's going to happen. Doesn't mean you should just dump all your investments and do all bonds. I'm certainly not recommending that. You have to make your own decision. But just know that if you're positioning yourself for looking out for the future, if rate cuts are about to happen, would you be better off in money market funds or high yield savings, or would you be better off in bonds? You have to do the research yourself, but there's definitely a strong case for looking at bonds as an option for you because the potential returns can happen in two ways with that price return, but also with the income generated from the bonds or the other fixed income vehicles. So I'm Derek Mazzarella with Gateway Financial Partners. Have any questions? Feel free to reach out.